All right, very well. Let's get started. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we're here to talk about the payrolls numbers that are coming out in just about 5 minutes. Last month, I got to say, tons of hand wringing about the Sahm rule. Some of it from people who don't exactly know how it works. Some people. Assuming that what we experienced in the past is necessarily going to play out in this current cycle, and it's more complicated than that. So we brought along the best guest, our best colleague in Bloomberg Opinion, to answer some of these riddles, Claudia Sahm herself. Claudia, let me have you sort of tee us up here. Um, we've got like 4 minutes before the number. What's going on in the labor market? What is the Sahm rule, and what's going on there?
Right. So the definition, let's put that out there. So the Sahm rule is based on the unemployment rate, the national unemployment rate. And the reason this time last month my day got turned upside down is that the unemployment rate ticked up to 3.9%. And earlier this year we had not just we had like 4 months where we were at 3.5%, which is very good. And so since then it's drifted up, and that has some concern, and there are people who have been calling a recession for 2 years now. So normally, as the unemployment rate starts to drift up, it gets some momentum going and it keeps going. The Sahm rule is based on that principle. So it uses the unemployment rate and essentially have a cutoff. If it gets high enough, then in history, and perfectly since the 1970s, we have been in the early months of a recession. So you can understand why people with the recession calls would be very interested if we are in fact in a recession. The thing that we have to keep in mind is this time has been very different. The logic of the Sahm rule is based on demand being destroyed, basically. And what we've seen, whether you do the supply chains, whether you've looked at the labor market, we have had some real issues with quote unquote supply, getting goods here. And we know, and we've seen this year in the inflation, those goods prices have in some cases been falling, right? So they're working themselves out. It's very unusual. We've had a lot of discussion. I've had a lot of discussion too about why we can't use demand tools like the Phillips curve. That has a corollary potentially in the labor market. We've seen labor supply shortages. We've seen companies really scrambling. That's why the unemployment rate went so low. If you wanted a job, you got a job, largely. And now we're on the other side of that. We had a lot of workers come back. The labor force participation rose this year. There's a lot of sources of that. And the employers have done a pretty good job hiring people back. So now we've got the jobs are trying to catch up with the workers, and they will. But in that process, now it's getting a little harder and takes a little longer to find, to find a job. Unemployment rate rises, and in that case, it means that disruption, just like we saw inflation come back down. Then in the good space, we can see this unemployment rate drift up as we finish this adjustment, stabilize, and frankly, I think drift back down. I think four and
Gotcha.
under is where we can settle. So that's the logic of the Sum rule and why it might not work this time, but it might, right? Like it's a powerful um, sequence of events because once the labor market starts not working for workers, then it stops working for consumers. So I don't want to be too sanguine about it.
Sure, sure. So, with about a minute to go here, I think what I take away from you is like we have to be careful about getting into this feedback mechanism where
Hmm.
workers start losing their jobs. That affects consumer demand. Corporations and small businesses start to feel worse, and the thing becomes self-perpetuating, basically.
Hmm.
So the thing to look for is if unemployment is rising, is it rising because people are losing their jobs? Is that a fair assessment, Claudia?
Right, and I'm trying very hard to not make Jobs Day about the Somme rule because it's a little frightening to have that happen. Places to look today, what's the employment to population ratio? What's the labor force participation ratio? I mean, those are important, and we have other data like claims, unemployment claims that have like still look really good.
Sure,
So,
sure. All right, so we're coming into the number here. This should be populating in just a second. Okay, so here are the numbers for everybody. Total non-farm payrolls comes in a little bit better than expected. We had 199,000 jobs, better than the 185,000 that economists in our survey were expecting, but private payrolls a little bit worse than expectations. You had 150,000 as opposed to the expectation of 159,000. So I guess something going on in the government level. But here's the interesting thing: since we set this up with a discussion about the Sahm rule, unemployment rate goes down. Unemployment rate ticks down to 3.7%. These are
Seven.
volatile
Well,
figures. Is that is that one of the reasons you made this a 3-month moving average and not just based on what the number is at a point in time?
yeah, absolutely. Right. And this goes for every single data point that we get from, about the economy is you have to take into account there are bumps and wiggles. This is a good, I mean, and 3.7 might not be where we settle either. Right. So I'm very happy about this. This pushes back against this. We have this upward drift that we're just on this path into a recession. But I'm not going to do some victory dance, right? And so and we have this extra dynamic right now where we've had so much disruption. I mean, think of anything we've looked at in the last 3 years to try and understand the economy. It's been a rough ride. So this is good news, but it's not victory. We're not fully rebalanced.
And labor force participation as well, also ticking up a little bit. We go up to 62.8% from a prior 62.7%. And as we speak, we've got some numbers populating on my screen on average hourly earnings. Um, we'll have to look under the hood at these. A lot of people like to remind me that it's not perhaps the highest quality measure of what's going on with wages and earnings in this economy, but 0.4% month on month, seasonally adjusted, is the increase in average hourly earnings. That's more than last month, and that's slightly more than folks had been expecting. Do you take any signal from that, Claudia?
I the all of these, again, back to my point about bumps and wiggles, right? None of this is like earth shattering. I think, you were talking about the average hourly earnings, this measure of wages. That's what measuring wages at this point, trying to figure out what's happening with wages, particularly wages inflation adjusted, has become like a cottage industry among myself and my peers. I have, and so this is one measure that today's numbers are not like average hourly earnings from this report are not considered like the gold standard of thinking about wages, but they're all moving in the same direction. Wage growth is slowing down. It is still extremely good relative to before the pandemic. So I don't think we should get angry about it. And it is something the Fed is watching. They've been concerned that it feeds into inflation. Essentially, the evidence for this is like super, super weak. But I mean, it's there, right? So I don't think nothing nothing here is alarm bells. And frankly, to see labor force participation tick up, I mean that in this report, and that's really good, right? And that's something the Fed will look at and say it's good. But again, labor force participation is notorious for like going up a little bit, then going down a little bit. Like that's just a tough one. Um, and I should stress a tenth of a percentage point. That's a big deal for labor force participation. Doesn't sound like much, but that's of a really big universe. I mean, that's out of the population. So
Sure. What would you say would be your story around labor force participation at this point? And is there much room for that number to continue to tick up? Because you talk about how if you just focus on the prime age workers, labor force participation looks very impressive. What's sort of changed? Structurally, you might say, in this labor market is a lot of older Americans dropped out of the labor force during the pandemic. there have been lots of wiggles, to borrow your
Mhm.
term, in that, but by and large, their participation is still well below what it was
Mhm.
pre-pandemic. And at this point, I think people are really wondering if that's ever going to change. That big baby boomer generation is continuing to age. Maybe they've said, "I'm out and I'm not coming
Mhm.
back." What could continue to drive labor force participation going forward, if anything?
In trying to understand where we're at right now in this recovery, moving into this expansion, it's important to look at the prime age. So the individuals between age 25 and 54, though, I mean, they're the ones that are like making the big contributions. That has labor force participation really dropped. And when COVID came, it made sense. I mean, people were scared. We sent them home. The caregiving responsibilities. I mean, people walked away because they had to. Women are a very good example of this. That has, uh, we saw it just to underscore how amazing this year has been in terms of with rebalancing the labor market. Women's employment, prime age women's employment in the United States hit an all-time high, right? And that, I mean, there's a lot of reasons for that. Some of it is getting us back to, out of this pandemic with the caregiving responsibilities, getting back to something normal. But it's also things like it's been really helpful to have the flexibility of working from home, right? And that's something that Nick Bloom, who and others who, really look at this, the work from home is staying, at least in the United States. So that's something that is more and more women or other individuals, workers with disabilities, hit an all-time high for their employment. And that's another group that flexibility makes a big difference. So those are trends that could keep going. And then a big piece of rebalancing that we're unlikely to see as much going into next year is the government finally got the work visas processed. And so we have more of the immigrant workers. And that basically went away during the pandemic because we weren't bringing people in. And now, like, they kind of came back in a rush. And so that's a big piece, I think, of some of this temporary unemployment rate is drifting up. We've got people coming in. It takes adjustments are hard. And so, this is uh, so that's playing out. The whole thing about total labor force participation and older worker, I mean, that's like its own long conversation. But with there, you got to really think about the demographic trends. People do eventually like to retire. And so this COVID was an opportunity for many of them to say, hey, enough is enough. I would rather just retire than die. And so, but there is this trend of labor force participation, and it's a very large demographic group. So I think the total, it's tough to parse. It's not totally about the rebalancing. It's like bigger picture um, trends. So, but the prime age labor force participation is what to look at closely, and it looks good. So,
Looks pretty darn good out there. Yeah, I did want to do a quick rundown of the market reaction here, and I sense that you'll have a good take on this. So you see yields really shooting up on this number, about 8 basis points on the day, and so the 10-year yield moves up to about 4.23%. This is a very volatile market lately, and so an 8 basis point move doesn't shock me. But in an earlier phase of my career as a financial journalist, it might have shocked me. It's a pretty big number. Um, to your point about the wiggles, I sense that, like, the argument that will be made in parsing this market data is like, oh, people think it's now more likely on the margin that the Fed will do an extra 25 basis points, or it's now more likely on the margin that the Fed will wait a few more months to
mhm.
cut rates. You worked at the Fed, Claudia. Does anybody over there really process a number like that, like
S-
that?
So I don't call moves in yield bumps and wiggles, right? Like I feel for you all that have to put money on the line. Uh, and although I wish I had that money to put on the line. No, I think the market has just been all over the place. I blame the Fed for this. Their communication policy is awful, and I'm fully expecting to be not happy when I see the summary of economic projections next week, because I think the world has been tough, but at this point it's pretty clear we are on the glide path to the soft landing, and inflation is coming down. So if they haven't been able to communicate a plan, it's inexcusable. Okay, so the Fed is not going to raise next week. I mean, this is no, 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 no. They're not doing that.
Not
The
a
big
chance, right?
no, there's no chance. Um, Although, as an economist, I should never say 100% chance, but I mean, it's
Never say never.
extremely low. Um, I have been and continue to be probably even more strengthened with today. June is the absolute earliest they are going to cut. So I don't know, people, I mean, people who had the first quarter baked in, they ought to be, this ought to be a wake up call today. And it's not like, I just think the Fed is very cautious. They don't want to be Arthur Burns again, make the mistakes in the 70s. When the labor market starts to cool, it's going to take some time to get Paul Volcker out of the building. So, they're watching the data. I think, personally, I think with labor force participation going up, I think that actually would probably just, I don't know, this is kind of a nothing burger in terms of how the Fed's thinking. But they're watching it. I like about this time they're having the scrum, so the staff meeting on the labor market. So, and I could be wrong. This is a tough time. I'm not happy with the Fed on their communication. I don't think they have a plan, like in terms of knowing already, have a sense. But it's tough. Like, I do feel for them. This is not easy, but today is good news for the world and for the Fed. This is like, you know, whatever. I think it'll help them reinforce next week. Hey, it's going to be a little while still before we cut. This ought to help
For
them
sure.
communicate. Um, but yeah, this is a wild ride. And markets, I hope they hold it together because they're my biggest risk factor for next year in terms of throwing us off the glide path.
Gotcha, gotcha. So let me just ask you to unpack a little bit, though. That
Mm-hmm.
was a strong statement. I think you said no chance that that they cut before June. Is that right? Um, and or I don't want to mischaracterize. Little chance,
Yeah,
let's
I was
say.
like, I don't want to
Uh,
say no on that because
uh,
who knows what happens between now and June. But I feel strongly, I feel more strongly than I think markets do. So maybe that's why I put a finer point on it. The other thing where I'm sure I'm out of consensus of anyone who's watching this is I don't think it matters. I don't think it matters if you do March or June or October. Like this recovery has not been, actually, this whole cycle has not been about the Fed. Supply is so important under the hood, and you know, Jay Powell didn't unload the docks in LA to get the goods off, and he's not working a second job, I hope. He's got enough to do. So, they have very limited tools for what are the big problems, what are the imbalances in the economy. So, them my concern of when they hike and if markets understand, and I mean, surprising markets is never a good thing. It's never the Fed's intention, but it is possible to do it. I mean, people can get a little jumpy. They got money on the line. So to me, it's not what the Fed does next year should have very little effect directly on the real world. So on employment, on inflation, which is what I care about. And at the end of the day, that's what they care about too. Um, but it could have effects onto financial markets. We've already seen some cases where financial markets get worked up because somebody's done bad risk management, like Silicon Valley Bank. And if those things spread, if there's enough like tension in markets, then indirectly it could go in to the real economy. That's not my base case, but that and US politics are my two big risks that I'm thinking about for the economy. But in both cases, they go indirectly into it by so that's where the Fed, to me, the Fed's got to get it right so they don't like throw financial markets into turmoil. Their communication policy has not been that bad, right? So I'm not really worried about that, but um, that's why I feel like I don't know, for a lot of cultural reasons, I think they're going to be slow to cut. And then on some level, it's like, I don't care, right? I mean, I do, and I'll talk, and I want to do lots of interviews on this. But it's just, I think, we have to separate out the Fed's effects on financial markets and the Fed's effects on the real economy. And this time, I mean, this time really has been different. Like we've seen this. The Fed is not why inflation came down this year, largely. I mean, they're in there, but that is not why.
do you think it's mostly been those supply factors?
Yeah,
The,
and you can
the
see it. I mean, that's where, it's the goods. I mean, goods prices have fallen for years. I mean, there's a lot of reasons, trade and quality adjustments. I mean, clearly what we're seeing is a much bigger swing. It's a readjustment. used car prices were not going to stay this high. That was a disruption of supply and semiconductors off into the new cars. So yeah, that's getting unwound. And you can point to a lot of things, and even housing, which we know is in train. There were massive disruptions with people moving around. Work from home caused some disruptions there too. So it's really, and the Fed had a lot to, the Fed totally mucked up housing markets, but that's a whole other story. So you can see it in the inflation data, because if you look under the hood and you see what was part of the spike and what's part of the coming back down, that's supply. Now, there are very credible arguments. I think Jason Furman has made this well, very data driven, that just because that's what this inflation decreasing has been so far doesn't mean that what's left isn't demand. And so that's the argument that the last mile could be the hardest. I don't subscribe to that view, but um, it's very plausible. And getting stuck at 3, the Fed will not tolerate that. Like, they will get us to 2, come hell or high water, and they know how to do it, and we won't be happy about it because they're, so. But it's not my base case, but I totally understand it. So, I'm probably, the Fed does matter, and it will play a role next year in inflation, but it's pretty clear. I mean, they raised over 500 basis points fast and unexpected, and the world just kind of blew them off, right? So I don't, and we've had time to adjust to that now. So I don't know.
Yeah, I see. I see what you mean, and then on the other hand, you know, I see a lot of hand wringing about how are they going to pull off the elusive soft landing? How are they going to pull off the elusive soft landing? And a story that I find compelling is this idea that pulling off the soft landing is essentially, a race to the bottom, or what's going to give first: interest rates, policy rates, or the labor market, right? So in that sense, timing does feel important to me,
Mhm.
but on the other hand, I'm pulled in another direction, and that direction is, like what's actually going on with the 10-year yield in some ways and in some markets matters a lot more than where that actual policy rate is.
Mhm.
And we saw the 10-year shoot up, and the trajectory has been back down. So in a way, we're seeing a lot of effective easing in places like the housing market and so forth, without the Fed really doing anything. And so why scramble? Why risk
Mhm.
sending the wrong signals? Do you agree with that, Claudia?
The thing that I'll be probably watching most closely for next week, and others, I mean, I'm not novel in this, is looking at the extent to which Jay Powell pushes back on what markets have done in terms of the yields coming down, right? Because, and last time, I mean, this is, yields have been really tough for the Fed. I mean, the last meeting, it was like, oh, if they're higher because of other factors than us, then we can hold it. Like, the Fed has been trying to figure out to what extent are markets doing their job this time. And there's always this tension between markets are not behaving the way the Fed, so they're like running at cross purposes. So Jay's had moments in the past where he's like, look, I can't tell you all what to do. Right. And just kind of like, you markets do your thing. And that's kind of like saying the Fed, we're just going to roll with this. And if they're willing next week to look at these yields down, and I think that's why today with yields going up, will help them. They can just be like, do your thing, right? And I mean, obviously they're looking very carefully. That will be a very heated discussion as to whether they're comfortable with markets doing their thing is working at cross purposes of the Fed. But at this point, I just don't see him saying that. If he were to try and push back on this and talk yields up, that would be a very hawkish signal next week. It'd be subtle, but I mean, markets would notice, right? Because, like you said, what matters for consumers and businesses are the actual rates they pay. The
Sure.
Fed, the Fed does not lend out to them, to people and businesses. I think one of the reasons the transmission mechanism is blunted this time. We see consumers were able to pay down a lot of debt. I mean, actually pay it down during the crisis. Credit burdens are still really low. Cash flows are good for businesses. So you have fewer, especially at this kind of a cycle point, people and businesses dependent on credit, and thus like the Fed's tool is through interest rates. And so like how does that work, right? Like if you can't get the credit, then you can't go buy the stuff you wanted to, and then the consumer, and then it goes into the labor market. But it's like you got to have that link. Somehow interest rates have to get into the real economy, and
Right.
that's been that channel for, I think you can actually tell the story. It's not just like immaculate Fed is cut out of the loop. I mean, there's a reason, and that's why their tools in the real economy are just they're really not capable of destroying a lot of demand unless they go big. Like another
And
500 would be basis points would be rough to absorb.
sure, sure. Let me start to wind us down here. I
Hmm.
wanted to have a conversation about your shirt, and um, I wanted to have a conversation about your shirt. A, because so much of what I now know and what I now know I don't know about the Phillips curve, I learned from you. I'm reading your work, um, and sort of a traditional, reading of the labor market would take today's 3.7% unemployment rate together with the observation that inflation continues to come down somewhat immaculately, and they they would say, wait a minute, like how is this possible, especially based on the assumptions of what we thought was full employment as recently as, like, I don't know, a year ago.
Hmm.
They they would say, how is what does full employment, just the term, mean to you? Do you have a number, and like what's your read of today's numbers in light of all of that?
The way I think of full employment is the way it was thought of when it was put in the dual mandate of the Fed. It's basically if everybody who wants a job can go and do work, they should have a job. And frankly, when it came in, it was like at a living wage. The dual mandate's history goes back to the civil rights movement. Coretta Scott King was there when they signed it into law, like the Congress, that especially the piece where the Fed chair has to go to Congress twice a year. As soon as it came in, economists did what they always did, did what they always do, and they redefined the dual mandate and said, instead of every worker who wants a job gets one, they said every worker who wants one can get a job as long as inflation doesn't take off. And frankly, from the get-go, full employment has largely been redefined in terms of inflation. Like it's just kind of this side piece, right? And they're always like, "Oh, we don't know what it is. We don't know what it is." But it's like actually see, and this has changed a lot under starting. I mean, frankly, Janet Yellen in particular, but Jay has carried the torch. The Fed is finally thinking hard in this space of workers need jobs. Like that was very clear in 2021 when they held rates low as long as they did. And then at some point, inflation, it's like we just can't wait for this to get down. I mean, they do have a dual mandate, right? And by the time they started raising rates, unemployment was legitimately low, and the labor market was really cranking, right, in terms of jobs. So that's a big step forward. This T-shirt comes from a group called Fed Up that predated this whole mess and had been working in advocacy with the Fed, really pushing them to think about it. Hey, you have a dual mandate. What does that mean? And they even met with the FOMC out at Jackson Hole. I think it was a few years, 3 years before uh, the the crisis began. And I have a huge amount of respect for them and the work they did. They're currently not. I mean, high inflation really kicked us full employment defenders to the curb last year. So, but I got my T-shirt. I think they printed them out in 21, and I thought it was a good day to bring it out again and share it with the Bloomberg folks. So,
Yeah, well, we appreciate it. But so let me just ask you about the number then. So, but like
oh yes.
before all of this, I think you would have been hard pressed to find an economist, at least on Wall Street, who would have told you that full employment was lower than 4%, right?
Hmm.
And here we are at 3.7%. So, looking at this combination of factors, does that tell you, like, A, full employment must be low, or B, this is just like not a very helpful conversation for the moment because it's more complicated than the conversation even implies.
It is not helpful, but I am happy to join the conversation. The Fed's estimate right now of the long run unemployment rate, like what would be sustainable, which often gets referred to as, the full employment, is 4%. And it has been that for a while now. You go back not even that much further, it wasn't 4, it was higher, right? So because this very low period of inflation before COVID, we had low unemployment. I mean, we had a long stretch of unemployment uh, below 4%. So it, I mean, honestly, the data can tell us it probably is below 4. How much? And it's probably close to 4. Like, I don't get too worked up about it. I do get worked up about the idea that we're going to use some made up number, whether it's U star, full employment, R star, the like mythical where the rate should be. I mean, like you have all these made up numbers that loom very large in the toolkit, like the more technical toolkit. And then you got people marching around with the Phillips curve that like, I mean, this is like generations ago came up, and that's purely a demand based tool. Right. And and to your point, that was telling us, and we heard it a lot last year, the only way to get inflation down is going to be for unemployment to be high. We need it to be high. And I said then, we don't need it to be high. And I can say now, I was right. And there were plenty of us. Like, I don't want to act like I was a lone wolf, but there certainly were the standard tools in macro would tell us what we needed to do as a recession. And the standard tools in macro were not fit for the purpose. And frankly, they hadn't been for a long time. So it was just like, what are we doing here? I do think the Fed is much more they get it. I mean, they have to make their decisions based on judgment. They have a variety of tools. And we know this early on, identified a lot of supply driven inflation. I mean, that was team transitory. We weren't just like, please make it go away. I mean, it was like looking under the hood. It just took a lot longer. I mean, and Jade said this recently, like, look, it was transitory, but it took 2 years and not 1 year, right? And the year in between was a rough year. So I get it what they have done. They needed to tighten. They're going to need to ease next year. I was disappointed with how much tightening they did and how fast. I thought that was a little reckless. Uh, and I'll be disappointed. I mean, they're gonna ease later than they needed to. The Fed behind the curve is kind of a thing, right? Like on both sides. So I don't know. But again, I was way more worried about the really fast tightening because I did think that had like a potentially a real shock and awe in financial markets and people like wanting to buy homes and all that. This time, I think they're going to go easy, like they're going to go slower and more with that, and we can absorb that. Uh, I hope. I mean, my God. so,
So to bring it all home here as we wrap up here, Claudia. So in other words, I would fully agree with you. You and others who have argued that increasing unemployment was a necessary condition to bring down inflation.
mhm.
I'm sorry, did I get that backwards? Yeah, everybody who has who has said that increasing unemployment was not necessary to bring down inflation vindicated in this by recent data and the experience of the past year. Another question, though, has been this argument that maybe it's not necessary, but maybe rising unemployment would be of this entire process. And we've seen it tick up a little bit, but it thus far, mercifully, it hasn't exactly played out like that. So we're going to be watching that in the months to come. Fair to characterize it as saying that you still think that it's possible that it will be a side effect? Is that
So in my like, I think the soft landing's in the bag at this point. Now that comes from another piece we haven't talked about. Consumers are in a really good place. Like there are people who have a cushion that haven't before. I mean, you look at what people tell us about their jobs and their income and their wealth. Most Americans are better off than they were before the pandemic. And before the pandemic, we were in a good place. So I see a lot of buffers. Businesses have got, I mean, fiscal keeps going around the corners on the Fed. We're into the place where those investment packages I mean, they're putting money in the pockets of businesses that normally would be interest rate sensitive. And
Right.
so to me, and then what's happening is we're giving time for these disruptions to work themselves out, to like rebalance. So I 2022 was a horrible year, and prices really did go up, and that's been a real challenge because inflation coming down is not getting prices down across the board. This year was the thank goodness, like that was supply. Like this was the vindication, and next year is going to be like we made it, and we're going to be like totally exhausted, and most people will still be very angry. But if we keep unemployment low and people have jobs and paychecks, and the prices stop rising so much, I mean, I'll take it.